In this example, we're going to look at the calculation of ending inventory costs under the FIFO method and the weighted average method. And then we're going to determine the lower cost of market based on those methods. So the lower cost of market is just basically when there is a decline in the value of the inventory over a period of time. The conservatism rule tells us that we should recognize and be conservative the one that has the lowest cost, okay? And then we have to account and determine if there's going to be a loss on the income statement based on that. So we're going to go through this, and then we're going to determine if that's the case in any of the situations. So the first thing we're going to do is we're simply going to find our ending inventory based on the FIFO method. So FIFO means first in, first out. That means the first items in are the first ones out, which means the first items we purchase are the first items that we sell. So in this scenario, we would sell our beginning inventory, then we would sell the first purchase, the second purchase, and the third purchase. So what that means then is that we have 10 units of inventory on hand, and we're looking at our ending inventory. So if I sold beginning and first and second purchase, that means what I have left would be these 10 units from the third purchase, okay? So in calculating the FIFO then, I'm going to take those 10 units times their cost of $30. And so that gives us $300. So that's the FIFO method. Our ending inventory, we have 10 units left for a total of $300. Then we're going to look at the weighted average method. So the weighted average method is where we take into account that there's a change over time in the unit price, and we're just pretty much going to average it all together. So the first thing we do is we find our average cost by taking total cost, which in this scenario is $970, divided by the total of the 40 units, which means that we had an average cost of $24.25. And so this is where you kind of want to see, does that make sense? If this was my price for all the varying units, if I did something wrong or had a calculation error, maybe I had $2.43 or something like that. Just this is where you want to see if it makes sense. So $24.25 seems to make sense as the average price. So then I take the 10 units that I have in my ending inventory times my average cost, and I have an ending inventory of $242.50. So from this point, if we used the FIFO method, first in, first out, my ending inventory would be $300, and if I use the average method, my ending inventory would be $242.50. Okay, but now we're going to take a look at the lower cost of market, and we're going to determine which item should be used and then prepare journal entries if necessary. So if we look at our lower cost of market, our FIFO cost from what we just did was $300. But if we use the lower cost of market method then, what would happen is our 10 units, it says down here, assume the market price, the cost to replace out in the market is $26. So if we were to use that amount, excuse me, our ending inventory should be $260. So it is more conservative for us to use that $26 for our cost, and so we would choose the market method, the lower of cost or market, and the market is the lower, so that's the method we would choose in this scenario. Then in part B, same thing with the weighted average method. Previously we got $242.50, but the market cost is $26. So in this example, we would use the $260. We would use our cost, okay, because it has a lower amount. The $242.50 is lower than the $260. So then in preparing the journal entries, we're going to have a difference of $40 from our FIFO method. So a loss on the write-down of our inventory of $40, and we decrease our merchandise inventory of $40 also to account for the difference in the market price and the FIFO method. There is no journal entry for part B, simply because the weighted average method that we recorded was smaller than the market price, so we don't have to make any adjustments.